Alphabet Corporation is just Google and YouTube for most people, but in the financial world, the company is one of the hyperscalers that is constantly researching and evolving. My name is Ivan, and welcome to Magna Trade. Today, we are breaking Alphabet down into 5 key areas: the sector, the raw financials, their competitive moat, the leadership team, and finally, the technicals and margin of safety. Let's get into it. You wouldn't want to say that Alphabet is strongly positioned in one sector. The business is usually divided into 3 main segments. The first one is Google services. They earn most of their money, and it includes Google Search, YouTube, and Google Network. Each of the components has its own way of earning money, but usually these are ads and subscriptions. Advertisements at Alphabet have reached a completely new level compared to its rivals due to new AI personalization technologies and others. And Google is responsible for 83.2% of the world's total searches, a fantastic number. The second one is Google Cloud. It's the fastest growing segment currently, due to high demand in AI infrastructure and corporate problem solving based on AI. Almost 90% of the Fortune 100 use Gemini Enterprise, and every minute Gemini processes nearly 22 billion tokens. Also, Alphabet produces its own AI chips, TPUs or tensor processing units, and we'll talk more about that later. Taking a closer look at cloud infrastructure, we see that among the big 3, Amazon Web Services, Microsoft Azure, and Google Cloud Platform, together they control around 68% of the market. The former controls only 11 to 12%, whilst Amazon Web Services and Microsoft Azure control 31 and 24% respectively. Still, GCP is the only one among the 3 that has been growing constantly since 2023 and has a lot of long-term orders. The third segment is called Other Bets. It's specifically focused on early-stage, long-term and high-risk investments. It's generally unprofitable and accounts for a tiny percentage of the corporation. Looking at the macro picture, interest rates are stable, and other economic cycle indicators don't show a possibility of a recession soon. Green light here. To begin with the income statement, and gross profit is above 50%. That's exactly what we want to see. CGA is around 45%, which is nice. R&D is not extremely high, taking into account the unique Alphabet structure. Depreciation and amortization are extremely small for a company that size. Interest expenses are low as well. Net income is higher than 30% of gross profit, which is perfect. All of these values are stable and have a positive trend. And if we also look at trailing 12 months, we see that this year huge growth is expected as well. On the balance sheet, we immediately see high cash and high receivables. But why do inventories equal 0? Actually, they are covered in the line Other Assets, because they are so small, less than 1% of total assets, that they became immaterial, and it's allowed to omit them in the 10K statement. Technically, Alphabet has some inventories, for example Google Pixel phones, but TPUs and data centers are never sold, so they sit in the property, plant and equipment line. The values there are high, but that's okay. Long-term investments are high and growing, yet again due to the unique structure of the holding. Proceeding to liabilities, both short and long-term debt started rising in the previous year. This is due to the AI supercycle, where Alphabet is trying to become one of the leaders. No preferred stock, all bought back shares are getting redeemed, hence zero treasury stock, retained earnings are growing fast, nice. Looking at some valuations, return on assets equals 22%, return on equity equals 32%, total liabilities to shareholders' equity equals 0.43. We'll look at cash flow on the quarterly statements. Even though capital expenditures are 40% of net income, which is nice, the company posted its first negative cash flow in 2 decades. They also issued stock to help balance the losses. And even then, it didn't cover the problem completely. The statements are a little bit confusing. Some values are great, some are scary. Why is this so? The answer is quite simple. Alphabet is making a huge bet on AI and cloud infrastructure, which might be both positive and negative depending on where they land after the AI supercycle. Though I strongly believe this bet might bring losses in the short term and reap the benefits in the long run. This company has one of the widest competitive moats in the world, and it, yet again, comes from many sources. The first one I want to cover is the fact that Alphabet is the only hyperscaler that controls every layer of the technology sandwich. Everything starts with the silicon, where Alphabet makes TPUs, their proprietary AI chips. Then comes the infrastructure. They have Borg and their own global internet cables, including submarine ones. That is, they don't run the highway, they became the highway. Then comes Gemini, which most people know and have used at least once. And one more not really visible advantage for Gemini is that no one has more information available than Alphabet. The last level is applications, Google Search, YouTube, Android, etc. They don't have to rely on Nvidia's chips or hope that someone will buy their product. They control 100% of the chain. Next comes customer acquisition cost, or CAC. The hardest part of the tech business isn't building a product, but delivering it to customers with minimal cost. Alphabet has a unique army of product monopolies. Android has more than 3 billion active devices. Chrome controls over 65% of the global browser market. And there are 7 more products with over 1 billion users each. Search, Maps, YouTube, Gmail, Play Store, Google Drive, and Google Photos. Why is this unique, you may ask? When Anthropic creates a new model, they have to convince the user not only to open their website or download the app, but also to start using it. When Google updates Gemini, they can integrate it into the Android smartphone or Chrome browser in one click. For billions of people, CAC equals 0. The Alphabet holding structure was a brilliant corporate decision that provides the company with the unique financial immunity. The search business and advertising acts as a highly efficient capital engine. They generate tens of billions of dollars in operating profit every quarter. This engine doesn't need a lot of money to keep working, so Alphabet can afford to spend $40 to $50 billion on capital expenditures every quarter, or fund unprofitable breakthrough projects without risking going bankrupt. For decades, the company was considered to have relaxed academic management. In recent years, though, the AI race has forced them to transform. Sundar Pichai has been the CEO of Google since 2015 and of the whole holding since 2019. His style is quite peculiar. Historically, he was considered one of the most careful, peaceful, and slow leaders. However, back in 2016, he already said that Google is AI first and silently but confidently invested billions in TPUs. Yet, from 2024 to 2026, he made a lot of dramatic changes, fired more than 12,000 people, united competing AI laboratories, and pushed the company to release new products even with flaws, breaking previous rules. Demis Hassabis is the CEO and founder of DeepMind, which Google bought in 2014. He is a genius neuroscientist and science engineer. After Pichai combined the independent AI team Google Brain with DeepMind, Hassabis received absolute control over AI development. He is the one responsible for the Gemini family. His approach is more scientific, and he also has almost unlimited resources from Google. Thomas Kurian is the CEO of Google Cloud. He transformed the cloud business from an underdog into a profitable giant. Previous leaders thought a nice product would sell itself. Kurian broke this idea and built a strong B2B sales machine focused on enterprises. He also made a bet that Google cloud would become the best cloud for AI development. And as we now know, he was correct. The biggest problem for current management is that Google search is under threat from its own product, AI overviews, and agents which give direct answers without needing to open a website. So management faces a difficult task, slowly implementing AI in search, but not too fast so as not to destroy search itself. For technical analysis, I use Bollinger Bands, MACD, support and resistance levels, and moving averages. We might find support at the $320 and $275 levels, and the 200-day moving average right above this level. Bollinger Bands have a channel with the bottom line in the center of the support zone. MACD shows the beginning of a new cycle. Price to free cash flow is 82, which is high, and current price to earnings is around 18, which is nice. Overall, we are close to a nice entry point, and if Alphabet rebounded back to the support level, you could confidently buy it. Still, right now, the price is not terrible, but not perfect either. When investing in Alphabet, you aren't betting on a specific sector or technology. You're investing in hardware, software, AI, and customer services simultaneously. We can confidently say that Google Search and YouTube are going to be around for more than 20 years from now. But the huge bet on AI and cloud infrastructure is a bit more concerning. For now, it's largely unprofitable due to the high costs of building data centers and training large language models. Fundamental analysis tells us that innovation takes a lot of money, and when it brings losses instead of returns, that's a real risk, not just a footnote. Yet, the company has strong management and one of the widest competitive moats there is. After weighing all the uncertainties, I still like the company, and I'll keep watching it for the right entry point. If you enjoyed this analysis, like and subscribe. We have a lot more companies to check. Share your thoughts on Alphabet in the comments below, and I'll see you in the next one. Peace.